It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of Bank Information. Take charge of your financial future with Your Personal Bank. Now here's Ference Toth.
Welcome to the Your Personal Bank Show. Today I thought I would cover some of the common questions regarding Your Personal Bank that I've received just this week from a number of potential clients and new and existing clients, actually. I've been in communication with a lot of folks recently, and there's been just a lot of good questions that have come up. I thought this would be a good time to cover it. So first thing I want to just touch on real quick, what is Your Personal Bank? How does it work? Really quickly is where it's a financial concept where we're taking two products, one from the banking industry, one from the insurance industry, and we're strategically integrating them to maximize returns and, most importantly, receive positive arbitrage. In other words, continue to earn interest on money even after you've spent the dollars. That's what makes this financial concept, basically unique. So how does it work? It's really quite simple. First step is we set up a high cash value insurance policy. Now, this is a policy that's designed to maximize cash. It's not something that most people are familiar with. I deal with this on a constant basis, and I'll talk about some of that here in a bit, about some of the reasons why most people have never been introduced to this idea or have never even met somebody who has some expertise or understanding. And I'm talking about financial advisors, CPAs, insurance agents, all of the above. So again, the first step is we set up a high cash value policy, and the purpose of this is to maximize cash values and minimize the death benefit, which happens to be the opposite purpose and use of how most people, view and use insurance. See, most people use insurance as strictly a death benefit protection plan. And in that regard, it's very effective. In fact, it's the most effective financial tool for death benefit protection. That's pretty obvious to most people. But frankly, that's a very narrow view of what insurance can do. There's many, many different things that it can accomplish, including, like I said, minimizing things like minimizing market risk, minimizing taxes, creating monies available for long-term care type expenses, creating monies available for emergencies or opportunities, and most important, or what people are really excited about, is the ability to create positive arbitrage on monies that are spent. Now, how is that done? We set that up with the second step. And the second step is we set up a bank line of credit where the cash in the policy is collateral for the line, the bank loan. And the key is the dividends that are earned by the policy are typically higher than the interest that's charged by the bank. So when you spend the dollars, when you spend the money, you keep the difference. Now, if you think about that a minute, that's really, really powerful, because where else can you actually earn interest on dollars you've actually spent, you've allocated and used, and they're gone? You paid bills, you paid off debt, you bought something with them, you invested the money, whatever. It's not in your hands anymore, yet you're still collecting some interest, some positive arbitrage. I want to talk about that further as I go through some of these questions on really how that works, but it's super powerful. And the question I ask people all the time is, well, if you're earning dividends, and by the way, what are the dividends? Well, we have companies that have been paying 6% dividends every year for the last 25 years plus. Also, these companies have never missed a dividend payment since literally before the Civil War. I mean, that's powerful. And we're talking about A+ rated companies, many of them household names you're familiar with. Tons of cash reserves, are fully prepared. They're in great position to continue to pay those dividends, frankly, for the rest of our lives. In fact, one of the companies, their CFO, was about a year or two ago, I was attending a conference, and he made a statement. He said, if we added no new customers today, we would be able to pay the current dividend rates, for the next 100 years. That's the kind of cash reserves and the dividend capability that these companies have. It's truly powerful, and it's exceptional. So, like I said, that's how it's set up. 2 steps. Set up a high cash value insurance policy, not one that's you've probably never seen. Most people have not, that I deal with, where you've got a tremendous amount of cash, typically at least half, if not up to 80, 90% of the cash available day one. That's what throws people for a loop, and they're surprised, pleasantly so. And then we set up the bank line of credit using the cash and the policy as collateral, and you access the funds through the bank line, and you keep the difference, the positive arbitrage. What are the rates? I told you the dividend rates already. We got companies paying 6% plus for the last 25 plus years. I'll show you the charts. In fact, I'll show you charts put together by the financial industry, not the insurance industry, just so you know, showing most of the top, basically all the top dividend paying companies, what they consider the top dividend payers for the last 25 years. It's a powerful chart. So contact me at yourpersonalbank.com, and I'll be happy to send that to you in addition to any other information or answer any questions you have. And like I said, then we set up the bank line, and the interest rates that are charged by the banks right now are somewhere between 3 and 3.95%. So my question is real simple. If your money is, say, getting a 6% dividend, and then you access the funds and you get charged between 3 and 3.95 when you actually use the funds, what's your money doing? And the answer, everybody gets it. The answer is quite simple. Your money's growing, isn't it? Your money's continuing to grow. You still have a positive arbitrage. You get to keep the difference. Now, one of the questions I get quite frequently is, and in fact, I get it so often that when I explain this to people, I've just gotten to the point where I just explain this before they ask the question, because I know the reality is they're probably going to ask it. Okay, I understand. I'm setting up this policy and I'm getting these dividends, and I'm showing the history of where they've been paying between 6 and 8% dividends for the last 25 years, literally every single year, consistently. And then I show them the bank line information and all that, and shows where they're charging between 3 and 3.95%. And again, that's based on the size of the account and that kind of thing. Basically, it's prime minus a half or prime minus a point with a floor, just so you know. So it's a really, really low rate. It's a collateralized loan. So this is some of the lowest rate interest rates you're ever going to get. One of the questions I get is, well, how easy is it to get qualified for the bank line? Folks, this is probably the easiest loan you'll ever apply for. Basically, as long as you don't have a judgment or lien, you're probably going to qualify. And why I mean that is, remember, the cash is in the policy. That's the collateral for the bank line. So the bank knows they're going to get paid. They know they're going to have access to the funds if you fail to pay them back, for example. So it's, again, most folks get approved within a matter of a few days. The application is literally one page. That's it. It's super simple. And it takes about, I'd say give it like 10 days, start to finish, from the application to the approval to the funding. I mean, that's that simple. These are FDIC insured banks. You get an account, you have access online. They'll even send you a checkbook if you want, so you can pay bills. This is super easy access to the funds. Okay, so that's one of the questions I get quite often. Another one I get is, okay, I understand if I'm earning dividends, let's say around 6%, let's say today, and the interest rates with the bank lines are in the 3s. Okay, interest rates are low right now. Agreed, they're generational lows. They've been that way for over a decade. What happens when interest rates change in the future? Well, the first thing I'll say is the Federal Reserve has been coming out repeatedly stating they're not going to increase rates. We don't expect for the foreseeable future, probably next couple of years or so. So we don't anticipate any changes of any significance for a while. But at some point, both the dividend rates, I already mentioned earlier, typically around high 5, 6s to 8% range, do fluctuate. And of course, the bank line interest rates are variable. So here, what happens? Well, part of showing the chart is really powerful when I do that, because it shows prior to 08-09, which was the Great Recession, and we had a significant change in interest rates after that point. They've been really low since. Again, very, very low rates. And the fact that we're still seeing dividends around 6%, even today, that's incredible. I mean, my gosh, look at the bank. Go to any bank and look at their CD rates or high interest rates, accounts, money markets, things like that. Ridiculously low interest rates, right? Even bonds and other kind of things. Mortgages are crazy low, historically low rates. So the fact that you can still see something like 6 or close to 6% dividends is powerful, okay? But what if rates change in the future? Which, at some point they will. Well, again, interest rates, bank line interest rates are subject to, the Federal Reserve interest rates are affected by that. Dividends are also affected by interest rates significantly because the primary thing that insurance companies invest in are bonds, basically, which are highly interest rate sensitive. So the point is, historically, both the dividend rate and that's paid to you by the insurance company and the interest rate charged by the bank basically correlate because they're affected by the same thing, the prevailing interest rates. That's their primary thing that affects them. So if we go back, say, prior to 0809, where interest rates were more normal, the prime rate was higher. Okay, let's say the interest rate on your a loan was, say, 5% now or something. What are the dividend rates you're getting paid? Well, they were all paying 7, 8%. So my point is, if you look from a historical standpoint, that 2 to 3% positive arbitrage has actually been in place, well, for the last number of decades. In fact, I have a document that's sent to me by one of the companies. I can get that to you if you want to contact me at yourpersonalbank.com. Be happy to send that to you along with any other information or, again, answer any questions you have. But in that document they were pointing out, and they showed where in the last 40 years, this is powerful, folks, really powerful. In the last 40 years, the dividends that you were paid versus the interest you were charged on the loan was a positive arbitrage every single month for the last 40 years, except for 2 months. And those 2 months had happened to be equal. So I can't guarantee you'll have a positive arbitrage scenario all the time, but the last 40 years you would have every single month except 2, and those 2 were equal. So didn't hurt you any, did it? And by the way, let's just say at some point in the future, when interest rates, say, start moving and maybe the bank line rates move faster than the dividend rates, that could be possible. And let's say they get out of whack. In other words, the interest the bank's charging happens to be a little higher than the dividends you're getting paid. Well, remember, the funds are in the policy. Could you just pay the loan off, the bank line? And the answer is yes, anytime you want to. In other words, you always have options. You always have control. You're always in charge. And then when the rates settle back down and get back to more normal, you just set up the bank line again. The bank lines are free in terms of there's no fees, there's no costs, there's no points, there's nothing. Okay? So there's no cost of setting up the bank line, and you only get charged interest on the funds when you access them. So there's really no downside to setting up the bank lines. So my point is, you're always in control, you're always in charge, and you're in control of your money. We're going to talk about some more questions that are very commonly asked, so stay tuned.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. And, well, today we're talking about a lot of the common questions that I get regarding Your Personal Bank in terms of how it works and how to apply it most effectively and those kinds of things. So I'm kind of mixing in some questions I get for both folks that are looking at the concept initially and then those who have had it in place and like what to do down the road, how to maximize its potential. So we're going to cover some of both. And like I said, the first couple of questions really involved the interest rate, the dividends you get paid versus the interest rates, and again, it's the positive arbitrage and the historical, the fact that historically you've had a 2 to 3% positive arbitrage situation. Like I said, just about every single month for the last 40 years, except according to one company's documents, 2 months out of the last 40 years, and those 2 months would happen to be equal. In other words, you were earning more in dividends than you were getting charged in interest when you access the money every single month for the last 40 years, except 2 months, and they happen to be equal. So that's pretty powerful. And if you missed some of that, I got into it more further in the first segment, go to yourpersonalbank.com. You can listen to any of the previously recorded shows, pass it on, whatever. And, of course, you can contact me if you have any questions or anything. Anyway, some of the other most common questions and things that come up is, well, I get this one all the time, why is my financial advisor or my insurance agent or something like that bring this to my attention? And I had a situation literally today with one of my clients who's been a client for about a year or so, and he happened to be at a conference, and he met another insurance agent at this conference, and he was talking about this concept, the personal bank concept, and And the guy, the insurance agent, he goes, yeah, I've been an insurance agent for like 20 years and all this stuff. It sounds too good to be true. I mean, he found it hard to believe that there were companies that were paying 6% dividends even today. He goes, most of them are like 5. That's true. Most of them are 5. But folks, there's over 800 insurance companies in the United States. There's a few dozen that really specialize and focus on dividends, okay, paying out dividends. Well, a lot of them, let me put it this way. Most of them pay dividends, okay? But there's a few dozen who are what's called mutually owned companies. Now, what's the difference? A mutually owned insurance company is one that's owned by it's for the mutual benefit of the policy owners. So you have mutually owned companies and you have stock owned insurance companies. Now, stock companies, they issue stock and, they trade on they trade in the stock market and all that kind of stuff. What's the difference? They both pay dividends. Well, the difference is the mutual companies have no stockholders. The owners of the company are literally the policy owners. Again, the mutual company is set up for the mutual benefit of the policy owners. And any insurance company you can think of with mutual in their name, there's many, many big names we've all heard of. There's Mass Mutual, Northwest Mutual, Mutual of Omaha, Penn Mutual, there's a bunch of them. There, like I said, there's a few dozen. These are all household names. Most of these companies have been around for over 100 years, literally. They have no stockholders. Now, why is that a benefit? Well, it's quite simple. They all pay dividends, but if there's no stockholders, they don't have any stockholders to pay dividends to, do they? Therefore, all the dividends go to the policy owners. So I ask people a simple question. If you want to maximize cash growth and maximize dividends, do you want to be with a company that gives you all the dividends or splits those dividends with stockholders? I mean, that's kind of a no-brainer. I mean, basically, the amount of, there's only so much in dividends companies can earn, right? And if you're not sharing, if you're sharing, you're getting about half the rate, half as much, right? So that's one of the reasons why a lot of insurance agents don't realize that there's companies that can pay up to 6%. Even today, and like I said, historically, in more normal interest rate environments, like prior to 0809, we're paying 7-8% routinely because they weren't sharing with stockholders. Okay, so the first thing is you want to make sure you have a mutually owned company. Okay, that's key to maximize cash, maximize growth, maximize dividends. Okay. So, but when he was sharing with me, he goes, gosh, that seems too much to be true. So this was a multi-day conference. So he told me the next day he brought his illustration. He brought his policy. And he goes, I'd sure like to see the numbers. Well, he showed him the numbers of his policy, his illustration. And again, the insurance veteran, who owned an agency, by the way, had agents work for him. He's been in the business for 20 plus years. I run into this all the time, by the way. This is not new for me. He goes, I just have a hard time believing these numbers. I've never seen anything like this. You get that comment a lot from financial advisors and insurance agents because the reality is they haven't seen anything like this. Why? Well, there's several reasons behind the why. A couple of the most common ones I find is they're just not working with the right companies that offer these type of products to maximize cash growth. I mean, there's some companies offer it, some don't. So if they're not working with those companies, they're not familiar with it, they would never be exposed to it, right? So there's just just a lack of familiarity. Okay, that's one of the reasons. Another one has to do with, frankly, a lack of education in our industry. And I want to tell you folks, from my personal opinion, it's basically pretty horrendous. I mean, it's not bad. It's horrendous. I'll give you a couple examples. I've had major insurance companies ask me to do breakout sessions at their annual meetings where they bring in all their top agents and talk about some of these very things, about maximizing cash value and creating positive arbitrage and all these things. And I remember at one of these conferences I was at a few years ago, I did a breakout session in the morning. And at lunchtime, 2 senior vice presidents of the insurance company were sitting across the table from me, and one of them said to me, "Man, that was an incredible presentation. You taught me some things I didn't know, and I've been working here for 20 years." And he looked over at the other senior VP next to him, and he said, "Some of that information Ference shared about our products was incredible. I had no idea they could do this. I thought it was mostly about death benefit protection." And he literally said this, "What was Ference sharing? Was it true?" Now understand, in the room were several of the senior execs of the company. There were some of the advanced markets people, many attorneys, various tax attorneys, folks like CPAs in the room when I was sharing all this information. And in the back of the room, they were all shaking their head in the affirmative. This was actually accurate, that their products could absolutely do these kinds of things, but it's little shared information. The two senior VPs across the table from me, the one said, "Yes, everything Ference shared is accurate, is absolutely true." And the other one's looking at it, he says, I had why didn't I know about this? Why? I had no idea. It's very common. There's almost like I said, there's I call it tunnel vision even. There's a tunnel vision view out there. And honestly, I can't even explain to you why it's so prevalent in the financial industry, in the insurance industry, even among insurance company employees and executives and agents, you name it, that insurance is strictly a death benefit protection tool. It truly is. It's a tunnel vision view. It's the only thing I can think of. I'm going to talk about in the next segment, because I'm running out of time on this. I think this is a very, very important point. Very few agents are taught this stuff or even brought into it. We have to, by the way, oftentimes educate the illustrators that work for the companies to show them how to illustrate their products properly to maximize cash values. In fact, I dealt with a situation on this just last week, which I'll talk about more and help you understand the reason why more. So stay tuned. Don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. And today we are talking about the common questions about your personal bank in terms of, well, not only in how it works, why people are not familiar with it, and also like how some of the things in terms of maximizing it for folks that already have it. So stay tuned. I'm going to be talking about some of those things. The last segment, I need to finish up a thought on, because it's so prevalent, about the question I get so often is, well, why? This sounds incredible. This is awesome. The positive arbitrage, eliminating market risk, reducing taxes, having access, liquidity to probably, majority of the money day one, funds available for long-term care type of expenses. You put all that together, it's a powerful tool, and it does a lot of different things. Why haven't I heard about this? And I was talking about in the last segment about the tunnel vision that the financial industry and insurance industries have regarding insurance in terms of what it can do. Overwhelmingly, I hear this so commonly over and over and over again about, well, insurance is a death benefit protection tool, and that's all it's for. Don't invest in insurance and all these other things. Well, if you're using it for the traditional use of insurance, strictly, okay, it may or may not be the best investment, but here's why. Here's the part people are missing, and this is what I want you to understand. So really want to pay attention to this. And I was talking about this and answering this question to a prospective new client this week. The situation is, if we want to just strictly maximize cash growth in a policy, we can do it. And like I said, we have policies, I'll show you policies that average over 8.5% average rate of return for the last 25 years, tax-free. We have products that do that and have done that with no downside market risk. In other words, they had no losses in any years, no negative years. They had an upside cap. Caps were around about 13% basically, upside. So what it meant was, if we use an index universal life product, for example, on a good market year, based on if the S&P 500 goes up, 10%, you make 10%. If it goes up 13, you make that. And if it goes up 15, you still make 13. Okay? But if it goes down, you still make the minimum 1%. So in other words, you're going to make somewhere between, I tell people, if you set up one of these, you're going to make somewhere between 1 and 13% a year, basically. It's average, the actual average return the last 25 years, 8.5%, tax-free. Income tax-free if you set it up properly. Folks, that's strong. That's very competitive. And by the way, the fees and the costs, minimal, because we're maximizing the cash value. If you missed that on some of the previous shows, I've talked about this so many times. Go to yourpersonalbank.com. But we're not structuring it like a typical insurance policy. We're maximizing the cash. So most of the money's going in the cash, and minimum amounts going in the insurance side. Okay? So we're really strictly maximizing cash growth. But here's what I run into quite often. Well, like this client I talked to a couple days ago, and he asked me this very question. And he said, I need to have a certain amount of death benefit in place for my wife and special needs daughter. But I want to take the money and maximize the growth. And I said, well, what you're saying to me is you want a hybrid. In other words, you want something that's going to give you a certain amount of death benefit protection, but also give you some growth. He goes, exactly. So I said, we may or may not be able to turbocharge the growth. We may have to pull a little bit back because we want to make sure you have a certain death benefit in place. He goes, you're right. So you have a hybrid plan or a hybrid of needs. And by the way, that's the majority of people, isn't it? That's the key. If somebody's looking to minimize income taxes, we're going to structure it a certain way. If they're looking to maximize growth, we're going to structure it a different way. If they're wanting to have some death benefit protection, we're going to structure it slightly different. In other words, addressing both or all three needs combined. Or if they're wanting long-term care monies for long-term care type benefits, which is built into no additional cost for these products. Okay, so my question comes down to is, well, what's most important to you? Cash growth, maximizing cash growth, minimizing taxes, making sure you have a death benefit in place for loved ones, making sure there's long-term care benefits available, money for that. See, what's your needs? And so what happens is many times we structure a hybrid plan or a combination of plans. Sometimes we do two plans. We will do one that's structured to maximize cash growth and another that's designed to maybe maximize death benefit or long-term care type benefits or minimize taxes or whatnot, right? So the problem that people run into is they view some of these hybrid plans, which are, by the way, much more common than the strictly cash growth ones. And then they view it strictly from a growth standpoint and say insurance is not a good investment. Well, if you're structuring strictly I told you, we can get you 8.5% average rate of return over the last 25 years with no downside losses, in other words, principal guaranteed, and income tax free if we set it up right. Or I can set you up with a steady Eddie consistent, show you companies have been paying 6% dividends even today and still have paid that every year for the last 25 plus years and never missed a dividend since literally before the Civil War. What's more important to you, steady Eddie consistent returns or maximizing returns? Or let me give you a third option. So if you stay tuned in the next segment, I promise I'll share with you what's the third option, which is better, steady Eddie or maximizing returns. So don't miss it.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. We're wrapping this up. Today we're talking about some of the most commonly asked questions that I get all the time. All of these are questions I've received this past week, both from clients, long-time clients, and folks who are just looking at this. And the last thing I was leaving on, which ties two of the questions together, in terms of, what's the focus? What's your goal in terms of the money? Are you wanting to maximize cash growth? Are you wanting to minimize taxes? Are you wanting to maximize liquidity? Do you want to make sure you're creating positive arbitrage? How about having monies available for long-term care type expenses? See, a high cash value policy can accomplish all of those things. And the funny part is we can also structure it in terms of maximizing liquidity or building long-term wealth. Okay, it depends on how it's structured and which is more important. One of the questions I ask folks all the time is, well, which is more important to you? Maximizing, you want to have a strong, high liquidity, like 80% of your money available day one through your bank line, create positive arbitrage. You got a chunk of money you want to do that with. We can do that. Do you want to build long-term compound growth over a period of time? We can do that. They're going to be structured differently, okay? Depending on what your goals are, what your needs are, what you want to try and accomplish. That's why looking at and reviewing these strictly from a growth perspective is not always the best. Well, they don't always compare the best. Look, I'll put up a strictly growth-oriented policy up against just about any investment out there, because again, I said it in the last segment. We've got products that have averaged an 8.5% return over the last 25 years with no downside risk and income tax free. That's strong. If you compare that to a taxable investment, look, if you've got investment invested even in an IRA or 401k or something like that, what are the taxes? When you take it out, you got to pay taxes, right? So, what's 8.5% tax free compared to for you? 9.5, 10 plus, depending on your bracket, right? So you can see where these can compare very favorably, and frankly, is why a lot of higher income earners, higher asset folks use this financial tool commonly. That's why banks use it, and corporations and wealthy families, offices, and all that use this very commonly. But there's also another option in terms of, are you wanting more steady Eddie, consistent dividend type growth? I've shared multiple times. We have companies paying 6% dividends even today, and have paid 6% or more every single year for the last 25 plus years, and never missed a dividend since literally before the Civil War. That's powerful. We also have another option where you can maximize your growth based on the S&P 500 index without any downside risk. You can make 12, 13% in a good year. You won't lose in a bad year. In fact, you'll make a minimum about 0.5% or so, no matter what the market does, what the S&P does. And again, don't forget, it's all tax-free. And again, the average has been 8.5% the last 25 years. You want more information on it? Contact me at yourpersonalbank.com. I'll show you. The other thing, and this ties in the two, and what I was going to say is, this is a question I get all the time. Should I go with the steady Eddie, or should I go with the maximum growth option? Should I go with the front load where I'm maximizing liquidity, or should I build longer term cash growth, long-term wealth, compound interest, and all that good stuff? Well, if you're on the fence, my answer is simple. Well, why not do some of both? No one said you had to do all front load, or all build over time, or all maximize growth, or all steady Eddie. So if you're on the fence and not sure which way to go, split it up. I have many clients who have some of both. I have some of both myself, because I have different goals for different purposes for those dollars. Okay? And irregardless, any of the solutions, frankly, are a great diversification tool, diversifying from, say, the stock market or other investments, cryptocurrencies or precious metals, or even real estate that involve risk. This is a option that has guarantees, and also is an option that doesn't have taxes. Look, if you think taxes are going to go up in the future, and based on what the Biden administration is talking about, sure looks like they are, doesn't it? And if the capital gains tax on the wealthier people gets instituted, that's probably going to have a serious effect on the stock market, which would affect people's, 401ks and IRAs, right? So if you're looking for a diversification tool, look, contact me at yourpersonalbank.com. We have some strong tools that'll do that and can accomplish multiple purposes at the same time, or we split it up and do a couple of different things to accomplish a couple of different goals, okay? I get that all the time. But the last thing I want to share probably, and then maybe a couple other thoughts, is, and ties in with a previous question that I was discussing, was most insurance agents or financial advisors that have looked at policies, cash value policies, when they look at them, the cash available day one, first year, is typically zero. Frankly, in most cases, it's zero for the first 3 or 4 years. Not with what we're doing, but what I'm saying is that what they're comparing to, what I call the traditional policies, that how they're structured. It's all in how they're structured. Folks, our policies that we set up are structured to have 50 to 90% cash available day one. I said it, and I'll say it again. 50 to 90% cash available day one. I see this all the time. I show this to people all the time. And this was an example that I was sharing earlier where the insurance, this client, who the insurance agent just couldn't believe what he was seeing. And he even said to this guy, well, geez, it's on the company. I would call the company and verify this is accurate, but I've never seen anything like this. And he was an insurance agent for 20 years. And what he was looking at is this client had put in $100,000 into one of these policies, and he was showing about $86,000 cash day one. This insurance agent had never seen anything like that because every policy he'd ever looked at or sold or dealt with had zero cash probably, or very close to zero day one. Look, $80,000, $86,000 versus zero is a huge difference, isn't it? And by the way, there's more cash not only in the first year, but every year thereafter. So my point is, we're maximizing cash growth, making these things move forward faster and quicker and more, than most people have ever seen. And we've been doing it for years and years and years. And like I said, I'm going to share another thought on why people haven't heard about this. I touched on this briefly in the last segment. When we work with a new company, now we work with multiple companies. I'm an independent, which is actually what you want, because we literally work with anybody. Don't really care. Just about every company out there. So we're shopping around all the time, looking at stuff all the time. But when we do work with a new company, we literally have to go through a process every single time. This is my personal experience. I've been doing this for 7, 8 years now in the terms of this part of it. I've been in the financial business and doing annuities and life insurance for over 22 years. But in terms of maximizing cash growth for people and getting the positive arbitrage, structuring these policies properly, we literally go through a process where we have to educate the illustrators, the professional illustrators that work for the companies, on exactly how to structure their products properly to maximize the cash. I literally go through the process and we sit down with them for several hours and over a period of typically a couple of weeks and show them how to tweak and adjust their illustrations to make this work. And when this happens, this has happened multiple times with multiple companies, they're shocked. They're blown away. They're like, oh my gosh, I had no idea that our products would do this. See, they were never taught it either. And these are the people that the insurance agents go to, say, hey, I need an illustration for XYZ client. And they're the ones that create the illustrations. That's all they do all day long. They're never taught how to do this stuff unless you get into the higher up advanced markets folks. Every one of the big companies has an advanced markets team, they call it. And they're usually filled with a bunch of attorneys, tax attorneys, and those kinds of folks who are very, very experienced. And they understand typically how to do this. But the typical illustrator for the typical company or the customer service rep has no idea. And sadly, we have to go through this process every time we work with a new company. And then once we do, we get our certain people in the company that understand this, and we have to get our illustrations strictly from them. We can't just take it to anyone on the team because they don't understand what we're doing. In fact, I had this happen literally last week with a company I've been working with for over a year. I have an agent up in Seattle. I actually have agents all over most of the country, by the way, because I used to travel the country and speak and educate in investor groups on the Your Personal Bank concept prior to COVID, that is. And invariably, there'd be somebody in the audience, oftentimes, who is an insurance agent, would be blown away, loved what we were sharing, and asked if they could join our team. So that's how I recruited agents. I didn't, frankly, for 7 or 8 years, I have not recruited a single agent to our agency. They've all come as a result of being introduced as a client or at a workshop, and they saw what we were doing, and they loved it and wanted to become part of the team. So one of my agents in Seattle, for example, and I live in Phoenix, by the way, he was working with one of our companies, and he got an illustrator to work that region, not in our Phoenix region. He got an illustration. This happens to us all the time from not one of the normal illustrators with the company. And he sent me an email and he said, I got this illustration. It looks completely wrong. It's all goofed up. It's not what I was looking for. It's not right. There's not enough cash values. I looked at it and I said, you're right. And I said, Greg, I forwarded it to my illustrator, my guy. And I said, please fix this and send it to our agent. And then please educate your illustrator that handles the Seattle region on how to illustrate these products to maximize cash growth for the cash availability and cash growth for the client, because that's what our agent in Seattle is going to need in the future. He did. He sat down with him for an entire half a day, he said, and educated him on how to do it correctly. Word is slowly starting to get out there. When I started doing this 7 or 8 years ago, it was almost unheard of. Now, every once in a while, I run into somebody who has some familiarity with this. But even when I do, I have yet, to date, met a single insurance agent, financial advisor, or anybody else who recommends the insurance policy, the cash value, high cash value policy to grow cash, and then also bring in the bank line of credit to create the positive arbitrage. In other words, you're earning more dividends than interest. To date, I haven't met one. I'm not saying there's nobody else out there doing it, but I haven't met one yet. And folks, I'm on the radio. I've been traveling the country for the last 7 or 8 years, speaking to groups of investors of anywhere from 30, 40 to 150 at a time. I've been on the radio for a couple of years. This goes out to, hundreds of thousands of people have heard me speak about this by now, and I've yet to meet one. So it gives you a little bit of an idea of how specialized or how rare this information is. Again, it's specialized in the high finance world. These are people who deal with banks, financial advisors that deal with banks, corporate finance boards, family offices, which typically have 10 million liquid assets and above. They're much more familiar commonly with this concept. But very, very few financial advisors or insurance agents, for that matter, deal with that clientele. I have some clients like that. I'm on a bank board myself. So I'm dealing with other bank directors and people like that and other banks. But the majority of the folks I run, are not in that situation. And they're just not introduced to this whole concept. So that's why I encourage you to contact me at your personal bank. Learn, I say this to agents and people like that are just not familiar. I say this with all the love in my heart that I can and as nicely as I can, but I say, look, you just don't know what you don't know. And just because there's something out there you're not familiar with doesn't mean it's not real. My gosh, in today's world, there's new stuff we learn all the time, isn't there? Even if you've been in the industry for years or decades even, doesn't mean you know everything. And I'm not going to sit here and say that I know everything, but your personal bank is something I know an awful lot about, and I've become one of the leading experts in the country on it. So contact me at yourpersonalbank.com for more information. And as always, stay tuned to the Your Personal Bank Show.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com.